The federal government posted a budgetary surplus of $1.5 billion in April and May. In its monthly fiscal monitor, the Finance Department says revenues rose almost 2% because of higher interest and employment insurance premiums. There were also greater proceeds from personal income tax and a carbon pricing hike. OK, we got fresh GDP numbers for Canada this morning. There was growth, apparently 0.3% in May. However, it looks as though we could have had a negative print for June with the economy slowing down. But that's just a preliminary read. Remember, we did get the unexpectedly strong start to this year. Our guest says Canada's economy is in fact stronger than the figures suggest. And he says it's a myth to think that our growth is simply tied to a recent surge in immigration. We're joined by Derek Holt, Vice President and Head of Capital Markets Economics at Scotiabank. Derek, great to talk to you.
Same here, Andrew.
Walk us through these latest figures. What do you think analysts and investors may be missing here in Canada's GDP numbers?
Sure things. The Canadian macro numbers are really tough to read for an extended period of time. If we go back even to late last year, we had a couple of train derailments to end the year. We had the section of the Keystone Pipeline back in December that was disrupted south of the border, and that backed into our energy patch. We shook off those shocks, and we went into new ones into the new year. Those included the federal civil servant strike in April that shut down much of the public sector and caused effects upon other parts of the economy. Then we rebounded from that, only to go into wildfires and then another port strike in the latest month. And so I think the important takeaway here is that when we cut through all of these distortions and control for them, we still have decent economic momentum in the Canadian economy.
Despite all these disruptions. Let's get to this thesis, really a fascinating one. You reckon that there's something of a myth out there that our economy is just being inflated by all these immigrants that we're bringing in. Tell us your thesis there, Derek.
Yeah, sure, Andrew. Okay, so there's a lot of casual empiricism going on. People are pointing to the fact that population has gone up, employment has gone up, GDP has gone up, ergo population must be driving everything else over the past year and a half or so. And it looks appealing in terms of that evidence on the surface, but Statistics Canada actually breaks down the job growth numbers by born in Canada and immigrant status in the country. And it doesn't bear out that hypothesis. For example, 84% of the jobs gained in the Canadian economy in the past 18 months have gone either to people born in Canada, 52% of the gains, and or landed immigrants who have been here for 10 or more years. That's a roughly 1/3 of that. And so the overwhelming share of the job gains over the past year and a half during which immigration surged have not gone to the recent arrivals.
That's interesting. I guess the other side of this coin, though, Derek, is our population is growing so rapidly. Does this mean that we inevitably are going to have lagging productivity per head? Because we've heard a lot of talk about this, that it's a major problem for Canada.
It could be a challenge over time. I mean, the interesting thing here, though, is that if it's not the new arrivals who are securing jobs, then they're not the ones driving the weak productivity. It's the people born in Canada and the longer-term landed immigrants who have been here for many years combined who may be the culprits in terms of that weak productivity. But I think we also need to look at, well, why is that the case? And there's a long list of reasons that we've perennially debated in Canada. We tend to underinvest. We tend to spend too little on research and development. We tend to have relatively lower technological rates of adoption. Not true in all instances, but as a general macroeconomic observation, that's generally true. And I think the way in which we craft our tax policies and some of our labor market supports also contributes to this, the reasons.
You think that the Bank of Canada would be ill-advised to look at disruptions from wildfires and read too much into that and think, well, we're done now hiking interest rates. Is it a case to go on raising rates?
Oh, yeah, I think so, for sure. And if we control for these shocks, then instead of having about 1% annualized GDP growth in the second quarter, after taking into account all of these various shocks, we might be dealing with about double that growth rate in the low 2% range, which is a little bit above Canada's non-inflationary speed limit to growth that most people estimate to be somewhere in and around 1.5 to 1.75%. And so that means the economy is not making that progress toward opening up disinflationary slack. It is still still in roughly in net excess demand conditions with a hot job market, a heating up overall housing market at the margin. And I think there's another inflection point higher in terms of inflation risk as we go on later this year and on into next year. So the bank has to be really, really careful that it doesn't waver prematurely here.
Certainly, this is completely unscientific, Derek, but this does not feel like a slack economy. I mean, it's hard to book appointments. It's hard to restaurants. Things are sold out. I know that's the Toronto area, and it's not scientific in any way, but this doesn't feel like a weak economy.
Well, your gut serves you well, Andrew. I mean, that's generally true. I mean, we have excess demand conditions across much of the Canadian economy still. And so at the margin, this explains part of why we have seen such strong inflation for an extended period of time. Now, we might be going through a temporary soft patch at the moment now. I'm skeptical that that's going to sustain itself. I mean, if we're still in excess demand conditions in the Canadian economy, we still have very, very tight job market. We're seeing collective bargaining arrangements in an economy with a 30% unionization rate across its whole labor force heat up those wage demands with more forthcoming, and food prices on the rise in the past couple of months. I mean, I go down the list, and frankly, I see more reasons to be still concerned about upside risk to inflation than downside on a trend basis.
What about this estimate from StatsCan, preliminary estimate that the economy actually shrank a little bit in June? You're skeptical there?
I am. I think it's healthy to be skeptical. I mean, Statistics Canada would say the same thing in all likelihood, that it's a flash estimate based upon very, very preliminary evidence, and they provide it in order to assist the community of economists, forecasters, and markets to try to get an early read, but it's subject to heavy revision risk. And one big area where that could be the case here has to do with the wildfire impact upon the energy sector that shut it down the month before in terms of the disruptive effects. And their surveys of what's going on in the energy sector notoriously lag and are highly incomplete in the first rounds. And it can take many months before you get accurate data on the energy sector rebound that might be coming once we eventually settle down in terms of the disruptive impact of these wildfires. So take it with a big grain of salt is the takeaway.